Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. We've got Bernard Pierson with us today. Bernard, without further ado, welcome.
Hi, Brian. Thanks for having me. Very
Oh,
excited to be
yeah.
here too.
Yeah, thanks for hopping on the show with me. This is awesome. So let's do this. Let's start out by talking about you. So tell us a little bit about yourself.
I'm Bernard, obviously. I've been doing real estate for just over 10 years, closer to
Okay.
12 maybe. Originally from Nicaragua. I was born in the US, but so I consider myself Nicaraguan American. I've lived here most of my life in Miami, which is where I live now. But my parents are from Nicaragua and I grew up in Nicaragua.
Awesome. Yeah, and I mean, we were talking just before we hit the record button. I spent a little time in Nicaragua. Fascinating place. A lot of really cool stuff there. One thing that I didn't realize, I guess I should have, is how many volcanoes there are in Nicaragua.
If you want to see lava, you can go down to Nicaragua and you'll see lava if you want to.
Yeah, just flying in, looking out the window, you see a bunch of, little circular things all around the place. And like, okay, that's a volcano crater. That's a crater. That's a
Yeah.
crater. That's a crater. But this was close to Managua, just kind of an aside before we get into your story. There's one of these volcanoes that you get up to the rim and they had like zip lines going all the way around. It was actually pretty
Mhm.
cool because you got to zip line over what was hopefully a very, dormant and safe, volcano, but it was still a
Yeah.
blast.
Yeah.
But anyway, let's skip forward and refocus on you. Tell us, how you got into real estate, and we'll go from there.
Yeah, absolutely. So before I got into real estate, I was doing some food trading, right? And it was very transactional. I made a little bit of money selling sugar, coffee, and different commodities, just on more of an export kind of thing, right?
Yeah.
So that's where I fell into real estate. I started thinking, where can I get more cash flow? Where can I get more of a stable business that will cash flow and not have to depend on that one transaction to make money?
Yeah.
And ended up doing real estate, ended up doing development, ground up development in Nicaragua and Costa Rica. Found some
Mhm.
partners, so I partnered up with them and who partners who had experience in development for multiple years, generational, and did development for 5, 6 years, and pretty quickly started finding out that that was also transactional, at least the one I was doing, which was just we
Yeah.
would build condos and single family home communities and sell them, right? So it was also very transactional because we would sell and have, we would have to start from zero again.
Mhm.
So at the same time, I had already been investing as an LP in
Mhm.
different syndications with different groups, be it office, multifamily, industrial, all of the above, right? So and multifamily was always my favorite. I was doing very well, and this must have been like 7 years ago, and that's when I decided to shift from ground up development to just buying multifamily value add properties.
Awesome. Now you mentioned, multifamily was your favorite at the time. Can you tell us why you preferred multifamily?
So I had a bias towards it because I,
Mhm.
I I was in the residential space already, building
Okay.
condos and single family homes. I've always believed in residential and more than other asset
Mhm.
classes just because it's a necessity. Not that the other ones are bad, right? I was also investing in it as an
Yeah,
LP
yeah.
in all the other asset classes, but my favorite was residential. Also looking at my LP investments,
Mhm.
multifamily was the one that was performing the best back then. This must have been 2014, 2015-ish, right?
Mhm.
And I already had a pretty decent sample size of different asset classes. And from my sample size, at least, multifamily was performing very well. And it was definitely the one for me.
Awesome. Appreciate that. So doing development, a lot in Costa Rica and Nicaragua, which once again, fascinating part of the world, great place to visit. But let's talk about your transition into multifamily. So you were in a similar space, you were developing, which there's a lot of similarities between the two. But what were the challenges you saw going from that development to multifamily?
So it was a different country, first of all. So the legal system is different. It's a whole different world.
Mhm.
And in a way, Latin America, be it Nicaragua, Costa Rica, or other
Yeah.
countries, it's a very challenging environment to work in. It's very different, like the way the law works. You have to have connection.
Or the way the law doesn't work in some
Or the way
cases.
the law doesn't work. That's a better way to put it, Brian. You're
Yeah,
right. Yeah.
exactly. Yeah. My
So it's
understanding is if you know the Ortega family, you can pretty much get whatever contract you want.
yeah.
But that's different.
Yeah. Yeah. So basically it just creates a very in general, and this is not specific to Nicaragua, in my opinion. I've done business in other parts of Latin America as well.
Yeah.
I actually travel quite often still
Mhm.
to different parts of Latin America. It's different, right? It's
Mhm.
challenging. And I did a lot of homework or analysis on investing in Latin America versus the United States. And it all pointed me back to the US. But going back to your question on the challenges I found was that Basically, even though I'm from the US, Nicaragua was home, right? And I knew a lot of people there. All my friendships, my childhood friendships were from Nicaragua. I could pick up the phone and call the head of a bank, if I wanted to get help with the financing or so basically my network there was very expansive. It's a
Mhm.
very small country, so it's easy to have an expansive network. And all of a sudden I find myself in the United States in a huge country where it wasn't nearly as easy to have that network. So the solution for me was to start networking, and
Mhm.
eventually, it took time, but the networking has been key to
Yeah.
where we are today.
Yeah, yeah. One last thing, when we were talking about it, reminded me, I was in Guatemala for a while during elections, and there was a guy, and I love this. His political slogan was "Ni corrupto, ni ladrón," which means I'm not corrupt, nor am I a thief. And so that was his campaign slogan, which kind of indicates, how things typically work down there. But
Yeah, if you have to
yeah,
say it,
so
if you have to say it as a slogan, it's for a reason.
yeah, exactly. If that's your political slogan, what else is going on down in the area?
Yeah.
But so culture shift for you, a big way of doing business. When you came over, you say building your network was the first thing you did. Now you're in Miami. Where did you decide to start investing?
My first investments in the US were in Miami, duplexes and stuff like that, single family homes. 2014-ish must have been the time. And this was at the same time I did do some LP investing
Mhm,
across the US. I guess as an operator or with my own investments
mhm,
on more active side, it was Miami. I did quickly realize I wanted to stay away from Miami. It's a great market. I was probably wrong. If I would have invested all my money here, I would have done very well. I did not, unfortunately,
mhm.
because I was looking for cash flow, right? And that's where I started expanding geographically. And I've invested in places like Georgia, near Atlanta, Arizona, Oklahoma, Kansas City to this day, and around Nashville, Charleston, South Carolina,
Yeah.
Greensboro, North Carolina. So yeah.
Nice, nice, nice. I mean, you mentioned seeking cash flow. Miami is probably one of those more appreciation ones, lower cap rates. Can you explain just a little bit why the search for cash flow? Why were you looking outside of Miami? Just go kind of one level deeper than what you already explained, if that makes sense.
For me, the reason I got into value add multifamily or just multifamily investing in general was seeking cash flow. I had been in that transactional business
Yeah.
already for a long time in the food trading, if you will, and then eventually development.
Hmm.
And we were making good money in both businesses, but it
Yeah.
was every 2 years or something, we would get a big payday. And that made us very nervous, right? Or made me very nervous to have to wait for it. Or will it happen? Will it not? You're taking a ton of risk. And as I would underwrite deals in South Florida or Miami, they wouldn't pencil in a way where they would give you cash flow. And it's proven to be a market that does appreciate or has
Yeah.
appreciated at least since then. But that was not my goal. My goal was to develop that cash flow. And
Mhm.
eventually, when I started taking investors, I did notice that for them was also very important to deliver that cash flow for them. So that's basically why I started looking for markets that do
Mhm.
have that high growth, but
Yeah.
also cash flow.
Yeah, and something I've noticed, I got into multifamily about 6 years ago. I was doing single family before that, but it seems like, some markets are strong at cash flow, some markets are really strong at appreciation, and it's almost like you can't get both, is seeming
Yes.
what it is. You can't get really strong cash flow and strong appreciation. It's almost like there's it's like the little slider on those equalizers, back from my
Yeah.
1990s boombox type stuff.
It's easy to make the mistake too, to just chase cash flow. So I'm not encouraging everyone out there to just go chase those markets with the high cash flow, because you may end up in the market you don't want. So be careful what you wish for or what you chase, if you
Mhm.
will, right? Because sometimes a balance may be the right thing. Sometimes it depends what you're looking for, and don't just chase that cash flow. And if you do, make sure that that's exactly what you want.
Yeah. I do like the idea of balance, I mean,
Mhm.
cash flow is important because you got to pay your mortgage, you got to pay your
Mhm.
expenses. And you know what? Investors really like getting those distributions, So I think cash flow is what keeps you alive. But going back to what you said, it depends on what your investment goals are, I mean,
Mhm.
for me, I like a little bit of cash flow, but I prefer the appreciation markets. But neither's right or wrong, kind of like exactly what you said. It depends on what you're looking for.
You'll probably make more in the long run. If you do it well, you'll probably make more money in the appreciation markets. It's a
Mhm.
lot easier to make a ton of money in an appreciation play than through cash flow. And there's
Yeah.
a reason the agencies have higher debt service requirements for what typically would be higher cash flowing markets, which are usually secondary and tertiary markets for them. And
Yeah.
there's a reason that they have these higher debt service requirements.
Yeah, I think that reason is because the markets that are expected to have a lot of appreciation attract a lot of money. All right. And because they attract a lot of money, prices go up. And because prices go up, your cash flow goes down, you know? So it's one of these things where the markets with higher cash flow are typically slightly higher in risk, which is why your
Mhm.
agencies are requiring a little bit more. They're not going to have higher prices 2, 3, or 4 years from now. They might have cash flow. They're not going
Mhm.
to have higher prices. So to put it, I guess, Barney style, I haven't used that word in probably 2 decades, but yeah, to dumb it down Barney style. There we go. Going back to your story, you started with seeking cash flow markets instead of the appreciation market in Miami. Have you stuck with that, or did that kind of change as things evolved?
I stuck with that. I'm not buying in Miami. It's a very expensive city to buy in. There's nothing wrong with Miami. At least with my network and our sources of funds, we can't buy the type of property that we want. And the type of property that we want is probably more like a 100-unit apartment building, Class B. And that would cost a lot of money down here in Miami. So, we're talking 300 or plus a door.
Yeah.
And we believe in our business model that once we hit the 100 unit per property or close to that at a minimum, we start getting the true economies of scale that we see. And we really like that Class B product or the 1980s, 1990, maybe 2000 build. And that's something that we feel we have better access in other markets than we do in Miami with our sources of capital, where we get our equity and financing and whatnot.
Yeah, awesome. Let's talk a little bit about that equity. I mean, when you came in, and let's talk about maybe evolution from beginning to where you're at right now. When you first started buying apartments, where did that equity come from? And kind of walk us through how that's changed over the years.
At the very beginning, it was a lot of personal funds, maybe some friends and family, and smaller
Mhm.
buildings, smaller stuff, 10
Yeah.
unit buildings, 20 unit buildings, and the check sizes were a lot smaller. So it
Mhm.
was easier to just do it with kind of like friends and family and maybe
Mhm.
personal funds. As time passed and we were growing, you quickly run out of money in this industry if you start buying with your own money. No
Yep.
matter how much money you have, you can have a lot of money and
Agreed.
you're still going to run out because you're
100%.
going,
Yeah.
yeah, because you're going to buy bigger stuff. So that's when we started talking more with investors and taking more investors.
Mhm.
And a lot of our investors are from Latin America.
Mhm.
And we noticed that, so a lot of them are in real estate already, right? They're basically developers, maybe in their home country, somewhere in South America, maybe Colombia, Chile,
Mhm.
Peru. And they have an appetite to be exposed to real estate in the US, which is the most stable market in the world, right? And once you're outside of this country, you start realizing it and start valuing it more. And they were looking to invest with somebody who was local here, lived here, had the experience.
Mhm.
We personally have that, but we also understand the culture, and I speak the language fluently. And it was very easy for us to connect with these family offices from
Mhm.
Latin America.
Yeah.
So we had that, I guess, connection or advantage with that source of capital. And that's been our main source of capital in the last 5 years or so.
Yeah, that's awesome. That
Yeah.
really is. With you being fluent, one thing I've noticed, and this is coming from, many years of traveling around, you don't have an accent in English. So I'm assuming you learned both languages when you were a kid.
Yes, I did. I was born here in the US and I
Mhm.
moved to Nicaragua when I was 6.
Okay.
So I kind of learned both languages in
Yeah.
parallel. And then I went to an American school down there and I would come back often. My
Yeah.
grandparents lived in DC and I would visit them often. Like we would spend summers there. So I've always been in both countries back and forth. So
Nice.
yeah, French,
Yeah.
US, and Nicaragua.
Yeah. I once had three US passports, each one a different color, but it's always the same name. No, I mean when I was traveling around a lot, I mean I worked a lot at different embassies and consulates, and I was always a little bit jealous of the people who did that because my Spanish was pretty good, but I could never do the accent free. I was never like perfectly fluent at it. But anyway, that was just one of those. I always wish that I could speak both languages just with that native ability.
Now with AI and all that stuff, you probably can. It's becoming a
Yeah,
lot
yeah.
easier. Yeah.
So yeah, make it a little easier. Anyway, back to real estate. Sorry, I keep on taking off these tangents that I find fascinating. But when you're bringing in foreign money, I know a lot of attorneys will say it is kind of difficult. There are other things you have to do, but what are the biggest hoops you have to jump through to bring in money from a foreign country?
From a legal tax perspective,
Mhm.
that is totally correct.
Yeah.
There's a lot of things you have to consider, and every country is going to be different.
Hmm.
It's not a one size fits all. It's not like, oh, it's coming from this country, so the same applies for a different country. Not necessarily. It may change. What we've landed on is most of our investors write bigger checks. I want to
Hmm.
say a million plus, or maybe 500,000 plus. When you have that, they usually form their own
Hmm.
legal structure. We do background checks and all and whatnot. We run them through the Treasury Department to make sure they're not on any blacklist or anything like that, as advised by our attorney. But do talk to your attorney and they'll tell you exactly what you have to do. But once they start writing bigger checks, what makes it easier is that you shouldn't really worry about what's most tax efficient for them, or
Mhm.
what's legally appropriate for them, or what they're going to want, because they're going to do it themselves. They're going to form their own structure. They're going to form a structure in the
Yes.
US, some sort of legal structure in the US. And then for you, they're essentially going to be a US investor, a US person, because that's probably what's going to work best for them.
Okay.
Now, when you have smaller investors, there is a challenge, right? Because then they may come in as foreigners.
Yeah.
But what you'll find out is in most cases, and this is not always true, but in many cases, you have to end up withholding and whatnot if they come in as foreigners.
Mhm.
And once that happens, you may lose a few of them, or they may go to their CPA or attorney and they're gonna tell them go form this entity and that, and it's gonna cost them so much money that they're not gonna invest.
Yeah.
So I would encourage you to focus on the larger check writers if you are going with foreign investors.
Yeah, and that makes complete sense. We may have had a couple of foreign investors come in, but if they did, they came with their own structure. I haven't had to jump through all the hoops with the like the individual foreigner in there as well. But I just know that my attorney says it's doable, but you probably don't want to do it if there's just one single $50,000 check writer. That's typically what I get from the attorneys, but interesting. So a lot of your equity has come from Latin America. You started out with friends and family money. You started out with
Yes.
personal funds. And 100% agree with you. It doesn't matter how much money you start with, you're going to run out. We're buying a $20 million portfolio. And we have to put 7 million out. And I don't care how much money you have. There's only so many times you can write that $7 million check, right? But for me, it's zero. And then you transitioned into, bringing in large chunks from Latin America. Here's another question. I mean, a lot of like family offices and equity sources in the US are being very conservative and kind of waiting for, the ball to drop, so to speak. Are you seeing the same thing amongst, the Latin American investors that you're bringing in?
We are, but less. So as bad as things seem here or feel here, they're worse down there.
Yeah.
So as much as inflation seemed bad here when it was at 9% or so, what was it, a year or so ago? Well, you have places like Argentina where it was 2, 3, 500%. So when things in perspective from Latin America look very good here, this is the safe haven. There's been a lot of new governments going to different countries in South America, and there's a lot of capital that, frankly, is seeking refuge in the US. So there's been good and bad for us, and in terms of investor appetite.
Yeah.
And from one perspective, there is a lot of appetite, and it's more the new governments that they're seeking refuge from, or
Mhm.
also maybe the inflation in Argentina has been something that a lot of investors have been seeking, just trying to leave the country for that reason.
Yeah. And you remind me of a quote that I've heard a lot, especially in Latin America. It goes like when America coughs or sneezes, the rest of the world catches a cold or something like that. So when we have just this little hiccup, the effects are amplified outside our borders. And I saw that, time and time again in Latin America and Argentina. Unfortunate that they keep on. I don't think they've ever had a really good stretch of years economically without hyperinflation. But it is a good point. A lot of people, in their country, we saw inflation peak at 9%. I think Argentina would love to have 9% inflation. But
Yeah.
yeah, I mean,
They'll do anything to keep it at 9%.
yeah, I mean, I was in Brazil for just over a year and inflation were mid-teens and they were okay with that, and it's
Yeah.
just like, yeah, it's a little higher than we want it to be, but we're not Argentina. But anyway,
The economy of Nicaragua, which is where I'm from, right, is about the GDP is about 15 billion, right?
mhm,
Miami-Dade is around 150 billion.
yeah.
So the US economy is gigantic. Like it's
Mhm,
4 times the size of the economy of Latin America as a whole, including the
yeah,
Caribbean. 4 times as large, just
yeah,
one country, and then against the whole continent. And the population in Latin America is twice as much.
yeah.
So, I mean, it's perspective.
Yeah, it is a whole different perspective, but
Yeah.
there still is a lot of wealth in Latin America. When you look at demographically, this might not be a good thing, but if for somebody like you that's looking for investors, the wealth in Latin America is concentrated in very few people. So even though the numbers are different, you looking to raise money, you tap into some of these wealthy families, and I mean, there still are a lot of really, really, really wealthy families down there. So
100%. Yeah.
a lot of opportunity. Well, awesome. So the last couple of years, our economy's changed a little bit. We've kind of had, a big sneeze of our own. How has your investment philosophy adapted or changed in the last couple of years? Say, post-COVID into the rate hike cycle.
That's a very good question. I'm fortunate. We don't have any bridge debt or any variable debt for that matter. All our debt is fixed. That was partially out of being conservative, but also we got lucky. I mean, I'm not gonna lie here and say, we were running away from bridge debt. Yeah, we were conservative. We didn't like it.
Mhm.
But would we have done it if the right deal came along? Maybe. Right.
Yeah.
So we did get lucky and also we were conservative in not having any bridge debt or any variable debt. So we've been fine from that perspective. Now, with this whole seeing how quickly the rate environment changed,
Mm.
especially after the Fed said it wouldn't, or at least they kind of insinuated it wouldn't, puts in perspective that we really can't predict what's going to happen in the economy or with rates or with anything. So you kind of have to prepare for everything.
Yeah.
And you really have to play defense when you're buying a property and when you're
Yeah.
underwriting and the way you structure your finance. So what we're doing now is everything we're buying with fixed debt, even though
Yeah.
we think, or I think my gut says that rates are going to go down or they're going to be lower, in 3, 4, 5 years than they are today. I don't know how
Mhm.
much lower. I have no idea if
Yeah.
they're going to be way lower or a little bit lower, but I think they will be lower. But we're still getting fixed rate because I'm not smart enough to predict it or to know where they're going to be. Or maybe I'm wrong. Maybe they go up.
Mhm.
Now, however, we are paying those extra bips, right, to have more flexible prepayment
Love
option and
that.
avoid yield maintenance
Yes.
and whatnot, right? So because what if they do come down? We want to have the ability to
Hmm.
capture that, that be able to refinance. And what is it that they say? You date the rate and you marry the
Marry the
basis.
deal? Is that what it is?
Yeah,
Yeah.
you marry the basis and you date the rate. So that's what we're heavily focused on that and we want to make sure we're dating the rate.
Yeah.
Because if you use yield maintenance, you're probably marrying the
You're
rate as
stuck.
well. Yeah.
Yeah. For people who don't know the difference, with your permanent debt, Freddie and Fannie specifically, the prepayment penalty can be a percentage of the loan. And one way to do it is a step down. It typically comes with a 5-year loan would come with a 5, 4, 3, 2, 1 step down. And what he's talking about is you can add a little bit, the lender will let you add a little bit to your interest rate to get a much more favorable step down. For example, I just signed a term sheet a week ago on a loan where we're getting a 3-2-1 step down. Basically, when we sell the property, we have a much lower prepayment penalty, which makes it easier for us to sell or refinance early and take advantage of rates coming down. And then yield maintenance, I mean, that just sucks. Just don't do
Yeah.
it.
Especially with the way rates are right now, right?
Mhm.
Because if they're very high, like it's gonna get even more expensive if they come down
Yeah.
the prepay. Yeah.
Yeah. So prepayment penalty on yield maintenance can be very, very high is the answer to that. So, well, yeah, I mean, one nice thing is, a lot of things you were talking about, I've said many times in the past. I think my ideal loan right now is exactly what I said, 5-year Freddie with that 3-2-1 step down, and you're still getting a decent rate, and you have the flexibility if rates do come down to just say, hey, we're going to pivot, we're going to refinance, and now instead of having, high fives, low sixes, we're in the wherever rates are at, so.
Mhm.
I think that's smart. I think that it is conservative. Your numbers, and just more speaking to the listeners, I know you know this, Bernard, but you can make your numbers look a lot better with bridge debt, but it is a little bit safer to go with that fixed rate product. So anyway, let's start winding down here. What's next for you guys?
So we are heavily focused in Kansas City more recently in the past year or so. We really like that area. We like it demographically. We like what's happening with the job growth. We just really like the city, right? And we also like our access to the deals we have there. So we're continuing to buy there. We're continuing to partner with family offices from Latin America. And we believe it's a good time to buy. It's not necessarily a great time to raise capital. It's not easy. And we believe that the reason it's a good time to buy is that it's not easy to find capital, right?
Yeah.
Although there is a lot of capital on the sideline. So once that capital starts moving, we think it's going to kind of like move in herds and all of a sudden things are going to potentially get good pretty quickly. So
Yeah.
we think it's a good time to buy. But again, it doesn't really matter what we think. What the capital thinks is what really matters. So we've been a lot less active just because we haven't gotten deals accepted recently
Mhm.
as much. We
Yeah.
have one deal right now we're under contract, for example, that I can't really talk about for SEC reasons.
Yeah.
But
Understand.
last year at this point, we had already bought one deal and we're under contract for two more. So it's been slower, right? But we think that's a good thing, and we think there's a lot of opportunity.
Yeah.
And we're really lining up our partnerships with our relationships to take advantage of this part of the cycle.
Yeah. Yeah, I agree. I mean, I was thinking about a really good analogy yesterday, and I happened to see two Corvettes, at a stoplight, and it's just like that's kind of what it feels like right now, in this industry is, two Corvettes at a stoplight. Now, these two cars didn't race when the stoplight, when it turned from red to green, but I think that's kind of where we're at right now. We got a lot of dry powder on the side, and a lot of people are waiting just for that light to turn green, whatever that means for them. They're waiting for that light to turn green, then it game back on again. So,
Yeah.
yeah.
But what I think is it's never obvious, right? It's never obvious when the right time is. And that's just the way it works. If it were, then we wouldn't have any discounts, right?
Yeah, and it is not going to be a very clear signal from red to green. I mean,
Right.
I wish it was, it'd make this job a lot easier. But I think a lot of people, when that first rate drop comes, that's going to be the signal for a lot of people. But that's not going to immediately mean that things are going to be good again. I
Mhm.
mean, it doesn't immediately, it's a quarter basis point drop in interest rates isn't going to change things substantially. But
Mhm.
anyway, I think a lot of this dry powder, they have their own line in the sand, their own, this is what that red to green looks like. But and when their own red to green turns off, I think we're going to see some exciting times. And like you said, I think we're going to see some really quick prices going up.
Yeah. I think that the better way to mitigate risk is to allow yourself to own these properties if you have to for longer periods of time. I think that's time is your best friend when it comes to mitigating risk. So if you aim for 5-year holds plus
Yeah.
horizons, I mean, I understand if you sell earlier, perfect rate, you have that flexible prepayment if you have to. But if you can really hold on longer, that's really gonna mitigate your risk. And 5 or 10 years from now, are you gonna be asking whether the Fed lowered rates in July or September?
No,
25 basis points, it's not going to matter.
no, it's not. It's not. And I 100% agree. One of the guys I partnered with recently made this point to me, talking about how to talk with investors. But he basically said one thing that I say a lot is we always plan for the worst and hope for the best. So we're going to underwrite these properties out to 10 years. We're going to show you what it looks like if, we hold with some very conservative, projections out to 10 years, but we're going to buy down our prepayment penalty just in case. We're still
Mhm.
hoping for the best. We're still hoping for that ball to fall or that, red light to turn green. But
I
yeah, I
love
think
that because it makes you be like this environment is making us all be conservative. We can't take a whole ton of that. Our LTVs are lower. We're all being conservative. Not everyone, right? But we're being conservative, right? With our assumptions, with our cap rate, sales analysis, or whatever, or terminal cap rate. We're all being conservative with these numbers, and there's a high chance that we're wrong
yeah.
for the better. Yeah.
High chance you were wrong. I tell people very frequently when they start asking questions about my underwriting, and this may sound terrible, but it's true. I'm like, every single number on there is wrong,
A hundred
but
percent.
every single number on there is wrong,
Yeah.
except for
The,
maybe
the
my
the
insurance.
only guarantee I can make is that we're not going to hit these numbers. Not the exact numbers.
Yeah,
Hopefully better numbers,
awesome.
but
Awesome.
they're not going to be exactly the same.
All right, so let's see. Where do we okay, so two more questions as we wrap up. What advice would you give to somebody who's just starting out as a multifamily syndicator right now?
I would really get familiar with the underwriting process, really underwrite as much as you can, get those deals off, even if it's not Crexy, it doesn't matter, even if they're fully on market. There's no easier way to get familiar with the market than underwriting, in my opinion. And you really start looking at those T12s and analyzing, just keep on underwriting, and network, try to find those relationships where you don't do this alone. It's a team sport. It's not something you do by yourself. I mean, you can, especially if you're not experienced, it's going to make your life a lot easier if you can find somebody with experience that you can get
Yeah.
started with.
Love it. Love it. That's stuff I've said many, many times before. So, and then the last question for you, how can listeners learn more about you?
Yeah, you can go on my website, www.ehpcapital.com. We just went through a rebrand, so it's ehpcapital.com. You can email me, bpearson@equitypartners.com. And equity, we spell it with an I at the end. That's
Okay.
for international.
All right, and we'll put a link to that in the show notes so people can if you're listening, you want to reach out, just look in the show notes and you'll be able to find it. So that's it, Bernard. Thanks for coming on the show today. Very much enjoyed this 30, 40 minutes worth of podcasting today, and you really added a lot of value.
Thanks, Brian.